Your first question, it comes from Tom Kierath from Barrenjoey. Please go ahead.
Morning, guys. Can I just check whether the MVM and US losses are expected to reduce in 25, and if that's kind of included in your outlook statement there?
Yes. Yeah, Tom. Yeah, they are expected to reduce, and that is included in our outlook statement.
Okay, great. And secondly, can you just elaborate on what the supply constraints are in the first half 25? Note that you're kind of flagging, I suppose, a bit weaker performance in the first half. Just when is that going to be resolved, and what are the moving parts there in that issue, please?
Sure. Tom, I'll answer that. So a combination of a couple of factors. Firstly, we finished FY24 with slightly lower stock than we had planned for, and that was really because of fourth quarter sales and DT shipments. Distributor shipments in China were pretty strong in the fourth quarter. So that mainly in relation to early stage product, particularly our trail packs and 400-gram tins. And then secondly, after year end, we've experienced supply constraints in infant. These are being addressed at the moment, but we expect these to be resolved in the first half. But they're likely to constrain our sales in the first half, and we're also likely to incur significant air freight in the first half to catch up ahead of sea freight shipments. And I guess lastly, the harder impact for us to quantify would be in relation to new user acquisition. It's always difficult to assess what that impact would be in the rolling impact of that going forward. But that's sort of, I hope that gives you sort of some colour on the challenge we're facing at the moment. It's not unusual in our industry. We've experienced this before. Last year it was more in relation to English label. This year it's more in relation to China label.
Got it. Great. Thanks, David.
Thank you. Your next question comes from Matt Montgomery from Forsyth Barr. Please go ahead.
Hi, David. Good morning. Just following up on Tom's second question there, I was just wondering if you could please, I guess, attempt to quantify the net drag of the supply constraints, and also what gross margins may have or may well net out at X the air freight headwinds. I'm just trying to get a sense of, I guess, the materiality of what you're calling out.
Hi, Matt. We're not providing specific guidance on the sales drag. It's hard to be too detailed on that, and maybe it'll have a significant impact on gross margin. What I could help you with, though, is the air freight is likely to be, quite significant. So it could be, $10 million or more over what we'd ordinarily experience. We do have air freight from time to time, but nothing of this magnitude.
Okay. Maybe we'll take it more offline. Then just on your supply chain, I guess post-Friday, my view at least was that investors probably had more foresight on the CapEx profile of the business over the next few years, i.e. you're putting your eggs in the MVM and Synlait basket, but you're sort of implying that you're still looking for potentially other site acquisitions. Firstly, apart from speed to market for new products, is there any other compelling reason as to why you wouldn't look to gain brand slots at Mataura Valley? And I guess secondly, is it opportunistic exploration of a new site, or would you say it's more likely than not you would look to partner with someone else or acquire a site yourself? Sorry, that's quite a long-winded question, but important.
No, okay. So let me know if I missed anything. So in terms of MVM and our ability to utilise that for China label slots, MVM is capable of achieving China label registration in time. The issue is that we would need to invest in blending and canning, which we have plans to do, but that would take some time to install that, to develop new product, submit dossiers, achieve semi-registration. That's a multi-year journey. Like, it's more likely to take 5 years or so. So that's why we are looking at other opportunities. Synlait will continue to be part of our supply base, and you probably noted that we've potentially got access to another China label registration there, and we're also partnering with Synlait on our US opportunity, subject to FDA approval as well. There's an opportunity over time to innovate and in-source English label product to MVM in partnership with the other supply partners in New Zealand, which we've currently partnered with New Zealand New Milk, which is a subsidiary of Lactalis, and also Yashili, which is a subsidiary of Mengniu. In terms of new investment opportunities, we are still actively looking at M&A and JV opportunities to expand our footprint, and there's two reasons for that. One is to really build and accelerate our nutritional manufacturing capability build, and then most importantly in the near term is speed of access to additional China label registrations. And in terms of focus area, that's both New Zealand and China. We have looked at other markets, but it's likely to be in those. And it's I would characterise it to your question. I won't be too specific on it, but it's not a high level exploratory. It's very deliberate. The work that we're doing in that area, which we hope will lead to tangible action in the future. I can't give you any guidance on what the shape of that may be all the time, but it's very deliberate.
Okay, thank you very much.
Okay.
No, I suppose, no, we'll leave it there. That's right. Thanks.
Thank you. Your next question comes from David Errington from Bank of America. Please go ahead.
Morning, David. Look, I've had a couple of incoming emails. People are confused at the moment with regard to this supply chain. So I don't have to burn up a question on this, but anyway, yeah, I think we need to clear it up. The consensus forecast, and I know you don't want to comment on consensus, I accept that, but consensus forecasts for 25 was the market was expecting you to grow sales probably by about 9% next year. And basically the margin, EBITDA margin, was expected to grow to 14.5% to 15%. So there's been a bit of a miss in terms of what the expectations were in 25 compared to what you're guiding. And as you said to Tom, that is even with factoring in reduced losses at the US and Mataura Valley. So this supply chain constraint is an issue that we need to clear up. I don't know if I fully understand yet what it is, why is it, and is it basically the key reason? So to get back to the previous question, the order of magnitude, can you clear this up, please? Because this is what's causing a fair bit of angst at the moment in the market. Because, and I still, to your answer to Tom's question, I still don't fully understand what the supply chain constraint is. And if you could clean that up, I think it would be great for all investors and people on the call.
Hi, David. Look, it's hard to be very specific about this. So in terms of growth, we're guiding to mid-single digits. Perhaps in the absence of this, we may have been mid to higher single digit. It's difficult to be very precise about it. And in terms of margin improvement, yes, we would have liked to have delivered more substantive EBITDA margin improvement. We're still focused on that at the moment, and we hope to improve EBITDA margins, but this is like in terms of potential lost sales plus the air freight cost is likely to temper any growth in EBITDA margins. And at the moment, our best estimates are that we'll have EBITDA margins broadly flat. Now, they could be up or down, but that's where we are at the moment. So it's quite a significant impact.
Well, what's the cause? I still don't understand what's causing this. I mean, you gave a bit of an answer, but is it one-off? Is it sustained? And what is it? Because at the moment, I'm at a loss as to what it is.
Look, David, it's difficult for me to... It's not appropriate for me to comment specifically on our supplier, Synlait, it's obvious. It's more operational and it's temporary. So it will be corrected, and we've had these problems in the past. And again, it's not unusual for the industry, so I'm not sort of blaming Synlait for this directly, but it does happen from time to time, and it's more probably for Synlait to explain. I don't want to speak on their behalf.
Okay. I think enough said on that. David, look,
second
question. I won't go.
We have a continuous supply chain, so if there is any form of disruption to the supply, plus as I mentioned, we finished the year slightly lower at the end of FY24, which doesn't help. But if there is an interruption to it, it does impact us, and so then we have to air freight to get ahead of the sea freight shipments. And production is being ramped up at the moment, but it just takes some time to catch up. So it's unfortunate. It's unfortunate. It's temporary. I mean, the more longer term impacts I mentioned could be on new user acquisition. That's difficult to quantify at the moment. But in terms of getting back into supply, we should be there by the end of the half, and I hope earlier.
Okay. No, I understand the sensitivity of the issue, and I fully appreciate the answer. David, look, I won't get... There's plenty of questions that are going to go into the nuts and bolts, but look, you're sitting on $1 billion of cash, and you're really doing the company, your operating execution's going great, etc. To meet your $2 billion of sales and your mid-teens margin, how much CapEx do you need to get that? I mean, because you're sitting on $1 billion, so how much excess cash do you to get to that $2 billion of sales, to get there, and mid-teen margin, how much CapEx do you need to get there? I don't think that question's been asked before, because then there's a lot of speculation, like you've got to have to build a canning facility and you have to do this, you have to do that. But to give us an idea as to how much excess cash is really sitting on that balance sheet right now, how much capital do you think you need to achieve your medium-term target of $2 billion of sales and 15-16% EBITDA margin?
Just firstly, can I clarify that our target is not 16%, it's not mid-teens, it's in the teens with you on.
I was fishing, I threw that out there for you, David, but you said $2 billion of sales, and I think mid-teen margins.
So I'll correct that firstly, David. In terms of CapEx, so if you refer to CapEx, then the CapEx is a lesser amount. So if we were to fully develop MVM and install blending and canning, I mean, rough numbers, you're talking about $100 to $200 million of CapEx to deliver on that. Yep. What we are, and potentially some China market investment in time, but that's likely to be a bit further down the track. In terms of the M&A JV opportunities that we're looking at for blending and canning or integrated facilities in New Zealand and potentially China, they could, depending on the nature of the opportunity and whether it is an outright acquisition versus a joint venture, that could be hundreds of millions of dollars. And the other thing that we're mindful of, and it's certainly not our intent, because we are supporting Synlait's recapitalisation plan, and the details of that will become apparent to the market shortly. But Synlait is also in a difficult position at the moment, and there's a possibility that there's risk associated with that. And Synlait is an incredibly important supplier for us, and we may need to support them more. So we're preserving our balance sheet to, I guess, a combination of de-risking our supply chain at the moment, and also investing in developing our own capability and market access for the future. We're not sitting on close to $1 billion, and for any other reason. It's in relation to that. And when we have more clarity over that, we'll be in a position to make an assessment of how to return how to return capital to shareholders in the most effective way. So it's for only those reasons, and I hope it's not too much longer, David.
How long do you need for clarity, David? A year, 2? Because what you're talking is fairly longer duration. How long do you need? No,
it's more like a year or 2, David, and I hope it's less than that. But I guess the key determinant in relation to this, we hope that all the Synlait recapitalisation process proceeds, so that will hopefully be clarified shortly. And then in relation to our own M&A JV opportunities, that's when you're always looking and dealing with counterparties, you can't be certain about that, but I hope that is within that time frame that you mentioned. We're not sitting on $1 billion for the next 5 years, if that's what you're thinking.
Okay. Well, thank you for answering the questions, David, and they needed to be cleaned up, so thank you very much.
That's right, no problem, David.
Thank you. Your next question, it comes from Adrian Allbon from Jarden. Please go ahead.
Oh, good morning, team. Can you hear me okay?
Yeah, can, Adrian.
Oh, thank you. Just staying on the supply chain, and you said you may give some more clarity to the settlement stuff with Synlait that you received on Friday. I think the term that you used was moderately higher manufacturing and flexibility costs. Can you sort of give us a bit more depth on what that means? Like, it's probably all contained within your teens target, but can you just sort of give us an indication of the changes there?
I think, just to clarify, I think Synlait said moderately higher manufacturing costs, and we said that our conversion costs would increase incrementally. So there's potentially a difference between those two statements. From our point of view, I'll let Synlait comment in time from their point of view, but from our point of view, we have an incremental increase in the conversion costs of certain of our products, and that's both China label and English label. It's not all products, and it's relatively incremental in terms of conversion costs. It's nothing to do with ingredients costs, because essentially it's a tolling relationship we have with Synlait. So when I refer to conversion costs, that's that part of it, and the ingredients costs we work together on to achieve the optimum mix of quality and term and service and costs related to those. So that's different. So it's a relatively that's a relatively immaterial impact on our product costs and margins associated with the settlement agreement, like very small.
Okay, understood. Maybe the second question, mate, this either for yourself or Johan, but just in terms of the English label category, like in terms of value share, I think you've noted it's gone to sort of 17%, was sort of 15%. Like, where do you kind of see that settling in the next couple of years? Like, do you think that the trend is towards 20, or like, can you just give us a bit more depth? Obviously, being yourself and Aptamil kind of 65% of that.
Yeah, so Adrian, just in terms of that split, you're referring to the English label share of the total market, China IMF market, which has improved. I think, if you look back in time, back to pre-pandemic, that rate was a lot higher, obviously, and English label has been impacted by COVID, and hence that ratio has come down. I think the improvement in the ratio is driven by a couple of things. So the first is, of course, no longer having the pandemic and that being a headwind to consumer choice. Second thing is, of course, in the current environment, English label products are considered to be more value for money, and that's influencing consumer choice. And then lastly, if we look particularly at CBEC and O2O and look at the competitor set, it's not only Fazan's label products, it's also products from Hong Kong and also from Europe. And some of the new products from Hong Kong and Europe have ingredients that are particularly attractive. An example of that would be HMO. And so those new products that contain some of those new ingredients are having particularly strong growth. So it's a factor of all of those that's driving the English label share. It's hard for me to say exactly where that would end up, but it's good to see that the momentum is back towards English label.
What was it, 23% pre-pandemic or something?
23.
Yeah, Adrian, who knows? I mean, it may increase a couple of points towards 20, but I'm not sure at this stage we'd be expecting it to go into the 20s.
Okay, no, that's good. Can I just think of one last one? Just when you, like, say if you take Immune and Move, when you launch those products, like, how long does it sort of take for you to be sort of net positive at the contribution margin? Like, how much marketing support is required up front for those kind of products?
Yeah, so there is a little bit of marketing support. I think what helps first is that Immune and Move build upon an existing portfolio. So we had the tub, the plain milk tub launched first, and then you have Immune and Move building on top. So it leverages a little bit of the marketing support already put towards the plain milk tub, but we invest in a little bit ahead, so probably about, say, 6 months ahead of overall payback. But ultimately, once it hits a steady state, we try to make sure that all the marketing investment is in line with the revenue generated.
And the fortified, faster growing and higher margin product.
Correct.
So in the second half, there would be a little bit of a drag from those new products and the actual margin contribution or in marketing costs, I suppose.
Yes, so some of that marketing cost happened in FY24, and a little bit will continue into FY25, and then we'll continue to expand the portfolio as well.
So they should have a positive contribution in FY25.
Okay, thank you for the answers.
Thank you. Your next question comes from Richard Barwick from CLSA. Please go ahead.
Good morning, all. I've just got a question about the $2 billion revenue target and where Mature Valley Milk fits into that. So am I right in saying you're assuming that MVM would be, by the time we get to an FY27, that MVM would be close to zero revenue contribution. And as I guess part of that, how should we be thinking about that transit or the progress at Mataura Valley Milk in the context of the dispute resolution with Synlait and the potential shifting of English label into Mataura Valley Milk?
Hi, Richard, it's David. MVM will help enable and develop our nutritional manufacturing supply capability in time. It'll help us with innovation in English label, but it won't help us in that time frame through to 27 from a China label market access and growth point of view, which I noted before. So whilst it might help us incrementally with growth, the bigger opportunity is to build capability for the future and also to work on reducing those losses over time, which we've said that we'll do that by FY27. So it's more of a financially, it's more of a loss mitigation earnings contribution in a way going forward. And when you think about it, won't be whilst the internalisation of those sales for A2 will reduce the external reported sales revenue over time from MVM, it's unlikely to be zero at that point. And the reason why I say that, like say for example, even, and this is not, I'm not saying these are our plans, but if you took even our total English label portfolio, and if we were to fully in-source that over time, you're talking about half the capacity of MVM. It's not all of the capacity. So we might be producing some other powdered and fortified products, but we're still likely to still be producing some ingredients products on the commodity market, particularly at the peak of the milk curve when we can't produce everything. The nutritional products. So so it's likely that insourcing or innovation will reduce external sales, but it's unlikely to eliminate it.
Okay. Well, I just think that's important for us to understand because in the context of the group targets, the $2 billion revenue at your teens and rising margin, then I imagine Mataura Valley Milk can actually have quite an impact because you'll end up with lower revenue. So I take it it's not going to be zero.
Yeah.
But presumably a positive EBITDA by then. So it would have quite a material impact on margin.
Agreed. It's a strain on the top line and hopefully an opportunity on the bottom line.
Yeah. Okay. Thank you. And the second question is just on birth rate. I know you mentioned that you're still expecting positive this calendar year, and I think your wording is sort of back into decline after that, or words to that effect. Is there anything you can add in terms of what you're seeing or hearing in market as to how positive the birth rate's looking for coming through calendar 24?
Well, it's difficult to be specific. We look at lots of different data points, and they still all suggest that, mostly suggest that the calendar year 24 number will be higher than what was reported in the prior year, which was the 9 million. So hopefully, somewhere between say 9 and 10 million, and hopefully sort of towards the higher end of that. Who knows? So we'll wait and see how that develops. Our statement about the longer term is that just when you think about the socio-demographic trends in the market, there's probably, I think we'd all agree that there's downward pressure on the birth rate over time. That doesn't necessarily mean that it's, calendar year 25 will be down. We're not saying that. That's uncertain at the moment. But when you look into calendar 26, 27 beyond, it's likely to have that pressure. And absent sort of changes in that or more substantive policy intervention or other factors, that's likely to occur. But having said that, it's still a massive market for us, and we're still relatively small share and got a big opportunity ahead of us. And also we're looking at growth opportunities outside of infant as well. And other nutritionals is a great example of that, up 37% and now $110 million business.
Yep. Okay, that's great. Thanks, David.
Thank you. Your next question comes from Phil Kimber from E&P Capital. Please go ahead.
Guys, first question was just around early stage infant milk formula. I was looking at one of your slides, I think it's slide 41. Your market share improvements in that early stage product is, significantly better than the other stages. And I think you're alluding to effectively that you had too lower early stage inventory because of sales in the fourth quarter were so strong. Is that correct? And I guess what's driving such particularly strong numbers in the early stage product, which, if you're going to have one of your stages strong, that's the best one to be strong because you got another, 2 or 3 years of strong sales in theory as a result. But if you can get a bit more colour around that, it'd be great.
Yes, I feel that your summary of that is correct. So in terms of the inventory, I'll let Shao talk to the drivers of early stage growth. But yes, we did. As I said at the outset, we did have lower. We finished the year with lower early stage inventory, both in English label and China label, particularly China label. And I mentioned the sort of the starter pack, the trial pack that we used, the 400 gram tins, we're short on as well. It's not as though we didn't have any inventory, it's just lower. And then when you couple that together with supply constraints, it creates a problem for us that we're managing at the moment. But Shao, do you want to comment on the drivers of early stage growth in China label?
Yes. Hi, this is Li Xiao. So, early stage is always, the focus of the China business because we know it decides your future growth. Yeah? So it's always about your discipline and balance allocation of your budget, where you are spending on driving your this year growth versus the future growth. Yeah. Saying that, coming to this fiscal year, it's what we call the Dragon Baby Boom year, and then there's even more focus, deliberate effort from the team. Like, there's both, new user early stage new user recruitment across online, offline, and also the medical channel. Plus, it's across EL and the CL. So you can see there are a lot of good initiatives, like we share in the half-year review about the what we call the baby swimming center, which is for the early stage. There's increased mama class on the maternity center, and also we kind of mobilize our resources on the medical platform. Recruit more user with endorsement and support of the doctor. And also you can see on the online, the focus is also to get more new user order. We launched what we call the maternity pack, which basically is a package for the pregnant woman. When they have a baby, they have the whole package solution, and plus, some smaller trial pack for the baby trial usage. So there was quite a lot of initiative and effort as well as budget allocated to this new user recruitment, leverage the Dragon Baby year so that we have more new user in the pipeline for the future growth.
Awesome, thank you. And then a question, just corporate costs, and I think I've got this right, were up quite significantly. They were down in the first half and then up about 10 million at the EBITDA level in the second half. I couldn't see any commentary on that. I might have missed it. But what was specifically driving that? Is it just sort of switching between halves, or was there something unusual in the second half that isn't going to carry on next year?
Hey Phil, it's Dave. So I think we may have said this at the half that our corporate costs would be weighted towards the second half. So it's mainly timing of certain. I'll call them project costs, or more related to science, so research, sustainability, etc. They're not necessarily one-off, so they're likely to recur from an annual perspective, but they were more phased to the second half. And I think our FX losses, which sits in a lot of it sits in corporate, was skewed to the second half as well. So it's a combination of FX and just the timing of certain corporate costs.
Great. But so that full year number and growth rate is sort of sensible, but don't fixate on the half year timing. Is that fair?
Yeah. Think about the full year. I mean, we're increasing capability during the year, so there might be some of that sort of run rate to come through next year, and then you probably just need to pull out the FX and take a view of what the FX will do next year, or just take it out completely. Hopefully that helps.
Thank you. Yeah, perfect. Thanks.
Thank you. Your next question comes from Lisa Deng from Goldman Sachs. Please go ahead.
Hi, I've got two questions. The first is around the starter packs that were quite strong in the fourth quarter. So if I look on also that page 41, we were up 26% for DOL and then, 14% for MBS. I'm surprised that doesn't translate, or is that doesn't translate into higher potential sales into FY25? So are we saying that 5% revenue growth is mainly due to a supply gap as opposed to, a conversion, issues? And then I think also on 400-gram tins, I saw a lot of gift with purchase, especially if we sign up with new member. Is that part of the reason for that margin drag in the second half as well? That's the first question.
Lisa, it's David. I'll let Dave comment on margin in a moment. But the starter packs, just bear in mind that those numbers on page 41 are share numbers. So you've got the total China market going backwards by over 10% during the year. But yes, generally, obviously, if we acquire new users in stage 1 and 2, that we have good loyalty with our brand that it follows through into stage 3. So it is it is impacted in part by that in the near term. We'll hopefully get another opportunity to acquire some of those users, but it does have an impact on sales. And our growth is not solely driven by that, but it does temper the opportunity we have in FY2025. And to David's question earlier, we would have hoped to be guiding potentially to a higher sales result, but at the moment, I think mid-single digits is a fair assumption at the moment. But that's also again, bearing in mind, we do expect the FY25, the total market to decline in China as well. So it's still representing pretty significant share gains.
And was the 400 starter packs a lower margin?
Yes, they're lower margin.
Yeah. Okay. Okay. The second question.
Sorry, Lisa. So you referred to the margin drag in the second half. Just to be clear, and we pointed it out in the presentation that we depreciated an additional 10 million. And that's gone through cost of sales. So that's impacting our margin in the second half.
Yeah, so then, if I actually reverse back that 10 million in the second half, the GP margin for the group is actually up year on year. So that's why I'm confused, right? We've actually spent more on starter packs, which are lower margin, but the margin x the 10 million is up. And then also, it's a great move if we can convert it to demand into 25, but then we've spent so much on this 400-gram starter pack, we've actually then stocked out in the first half and we can't catch it. So it's is that kind of what happened?
Sorry, Lisa. We're trying to give a little bit of colour on what's happening with our inventory and the constraints we're facing at the moment. So we don't spend an enormous amount of money on the starter packs on the 400-gram tins. They are lower margin. They're used as and they're sold online and in store, but also used as part of a starter pack and gift with purchase and things like that. So don't think that is the kind of key driver of that. I was just trying to give a little bit of colour around how our inventory levels have been impacted by this. And I just said, look, it's more in, I guess it's more in China label, it's more in early stage. And, I just gave an example, particularly in the 400-gram tin. So, but the gross margin movements, that's not driving a big impact on that.
I see. Okay, cool. The second question, if I may, is then why do we want extra 3 sets of China label registration? Because I see that there's a big overlap in terms of price points, and then also with the English label doing super premium soon as well. There's a very large overlap in price points. So capability or formula-wise, what would be the differentiation?
Yeah, so that chart that we shared was conceptual. We're just indicating that we'd like to expand our China label range over time, and they'll be at similar or different price points to our current Zhichu range, and they'll have different benefit propositions and formulations for our consumers going forward. But we're not going to talk about that explicitly because that's obviously commercially sensitive. But when we look at the China label market overall, if you look at the top 10 players that we've listed, top 10 brands, their China label portfolio ranges from 3 to, I think, 27 brands that they have registered slots. And so that enables them those competitors to appeal to more consumer needs as you segment the market and also to manage the trade more effectively over time. And we're not saying that we need anywhere near 20 registrations, but a handful of registrations would be very helpful for us to manage the trade more effectively. English label, we are free to innovate and bring new product to market. Our range is expanding from 1 to 3, and it may do so more in the future. We're just providing an indication to the market of what to expect in the coming years. We talked about this originally back in 2021 when we outlined our strategy refresh, but we just thought because of us bringing new English label products to market last year and this year currently, and also having the opportunity to gain an extra slot with Synlait over time, we just want to provide a little bit of context around that.
And then in terms of the 1 billion potentially looking for M&A, would we consider a sizable outside of IMF acquisition, such as in, call it whatever, nutritionals, vitamins, that type?
That's not currently part of our priority. Our main focus is on investing in and building nutritional manufacturing capability and market access to China in infant. We're open to acquisitions in adjacent, near in adjacencies of us to develop our business. It's not obvious at the moment what that would be, and we'll look at that over time. But we've got a great opportunity with the wonderful brand that's been developed over many years and invested in to expand our product portfolio around that, our penetration in our existing markets, and also to take that to new markets over time. And Vietnam is a great example of that, and hopefully we'll get the opportunity in the US with infant in the future as well. So we think we've got terrific organic growth opportunities. We're not going to take $1 billion and invest that in acquisitions for other brands and categories to expand our business significantly because it's got so much of an organic growth opportunity. It's mainly focused on supply chain.
Got it. Thank you.
Thank you. Your next question comes from Stephen Ridgewell from Craigs IP. Please go ahead.
Yeah, good morning. First one for Li Xiao on competition. A2's continued to gain share of the overall market in FY24, but it also looks like it's lost a bit of share of the A2 only categories we've seen for a number of years now. Just interested in which other brands gain share of the A2 only category over the year, and does the guidance assume these market share trends, within the A2 only category continue into FY25, please?
Yeah, so we see that in the new China label registration, almost all the top 10 competition launched their A2 product. From a basic A2 to A2 organic or A2 plus. And you probably noticed that Yili is probably the most ambitious and determined player. That almost upgrade most of their SKU to A2 or A2 organic, and trying to have a bigger presence in the A2 segment. So based on our contact tracking, I think because of everybody, a lot of players are launching their new A2 product or upgrade their existing product with A2 base powder. So we see this segment is growing more than 50% in volume and 40% in the value. Yeah. So I think that's both good news and bad news. Bad news is there's a much more competition, especially when you have an ambitious player like Yili. Yeah. The good news is with this collective market effort, there's a much more education penetration in the A2 segment, and also you see that our brand health tracking, our A2 pioneer and the leadership brand equity is still ranking at 62 to 63, which is a very high level, and with a previous obvious gap with our competition. So it means that probably we are going to have a less share, but we are going to keep on growing, riding on the A2 good momentum, while we are also strengthening. While the category grow fast, so now our focus shift more on our A2 brand superiority as a pioneer and a leader. Partially the efforts go to the how to grow the pie bigger, educate the consumer. Yeah. Does that answer the question?
Yeah, and Yeah, that's great. Thanks. And great execution over a number of years in China label. Maybe just switching to the US. Just interested, David, in your view of the early consumer reception to the launch of US label infant formula this year, and is it sufficiently encouraging to warrant a broader market launch over time, and the costs that obviously being incurred to secure long-term FDA approval? And then kind of second part is, what revenue does US label infant formula need to achieve for the US business to break even in line with the revised targets, Dave, FY27, please?
I'll start, and Kevin may chime in as well. So on the market reception, look, it's been modest to date because we haven't really pushed it that hard during this period of having enforcement discretion approval, but not longer term FDA market access. So we've actually invested more and focused more on getting long-term access, and we shared in the presentation that we've completed our growth study, and it's hard to tell, but I think we're one of the first to complete the growth study, and we hope to be submitting our long-term application shortly. So hopefully during the course of next year, we'll get that long-term application. And then from a retail partner point of view, that will open up, I guess, on the back of more confidence and certainty in our presence in the market, that should open up more opportunities for us. In the meantime, we've been just experimenting with different propositions and trialing in Amazon, and to a lesser extent, we've also online with Walmart. They're very small businesses at the moment in terms of their distribution and sales, but the reviews have been okay. I don't know, Kev, do you want to comment?
Yeah, I think what is encouraging for us is the success of international brands that have come into the marketplace in the last year and a half, 2 years. That's given us great encouragement. We have, as David said, we've been particularly focused on ensuring we get long-term approval. So that's been where we have most of our efforts have been. And as we said, we're due to submit our NIFN submission in the next quarter. And we have been trialing various methods, and there's been the premium segment specifically, and imported brands are performing quite well. So we've been very encouraged with the early signs. There's a long way to go, but there's some international brands that have got good sizable portfolios in the last 2 years. So we certainly have ambitions on those sort of numbers.
In terms of the sales required to break even, the profitability of our liquid milk business has improved a lot in recent times, and as Kevin said in his presentation, we expect to get to break even in 26 on that. The real question for us is in relation to infant. We've got great supply out of Synlait, and cost structures associated with that. It's a question on how much in marketing do we need to invest to realise that opportunity going forward. So that's why I said we need to sort of get a better understanding of the opportunity and investment levels required to deliver that. So liquid milk break even in the not too distant future. Infant, I hope that we can manage that and without investing a lot in the P&L, but it'll depend on our conviction at the time. If we think there's a significant opportunity for us, we're not afraid of leaning into that and investing behind that. But at the moment, we don't have that conviction at the moment, particularly while we're waiting for ED approval, and that may change over time. But otherwise, at the moment, our intention is hopefully to just invest the margin that will derive from the product into marketing investment, maybe a bit more than that, to see how we can gain traction over time and hopefully get some support from some of the major retailers. So it's a bit early to tell, Stephen, in relation to that.
That's great. Thank you.
Thank you. We do only have 5 minutes remaining on this call. Your next question comes from Sam Teeger from Citi. Please go ahead.
Oh, hi, David and team. Good morning. Just for the mid-single-digit revenue guidance for FY25, can you talk us through what's assumed in there, if anything, for the 2 new infant formula products and new markets such as Vietnam? Just thinking about potential upside scenarios, and also on the downside risk, what's the level of confidence that this supply disruption is going to be resolved and won't get any worse?
We're not, Sam, hi. We're not really in a position to provide specific guidance on those new products being introduced, but perhaps to give you some shape around the business and where we're thinking the growth will come from. So overall, in terms of mid-single-digit revenue guidance, we're thinking that at the moment, our total IMF sales would be broadly consistent with that, and probably English label ahead of China label this year, which is different, with China label more constrained by supply than English label, but we'll see how that develops. And for our milk businesses, US and Australia, probably low single digit on average across those, maybe different by region. Other nutritionals should grow well, probably not at the same rates that we did this year because some of that was innovation coming to market plus some supply issues in the previous year. But that should grow, maybe certainly double digits, but not perhaps at 37%. And then MBM is a bit difficult to tell. That could go either way, but you might want to assume that's flat or maybe we're bringing in more milk supplies. That might be up a little bit, but it's a bit hard to tell in relation to MBM at the moment. So hopefully that gives you some shape around that.
Yeah.
And the supply constraints,
yeah, that's really helpful. But
we do expect. Yeah, keep going. You go.
No, you go.
Oh, so just on the supply constraints, we do expect those to be resolved during this half. Synlait's ramping up production, so we don't expect those to get worse at this point. And if it did, we'd certainly let the market know if it was material.
Okay, but that's really helpful, David. Thank you. Just trying to understand for the new innovation, have you assumed anything in the revenue guidance, or if that's successful, is that further upside?
No, it's in the revenue guidance. Sorry, I thought you were asking me to quantify it, but we do have, for example, Gentle Gold starting to ramp up, plus a new product that we're going to bring in the English label portfolio in the second half that's in there as well. So they're all part of that, including stuff that we already have in market and the other nutritionals products as well.
Perfect, thanks. And then, great to see all this new development coming out of the company, and hopefully it does help you accelerate revenue growth over the medium to longer term. But is there any way you can help us understand the magnitude of any margin drag in the short term in FY25 as you launch these new products, given you won't be doing large-size commercial batches until you get comfort that the demand is there for them?
Yeah, it's a great point. Like particularly in infant. So sounds like you understand the manufacturing process well. The cost of producing smaller base powder runs and blending and canning is quite significantly more at smaller volumes. So at an individual product level for Gentle Gold and the next product that we bring to market, yes, there'll be significantly lower margins until they get to scale. And those when the product starts to get to in the order of 1 to 2 million tins, that's when you get back to closer to normal manufacturing economics. But certainly less than 1 million tins, it's a drain. But in terms of overall impact, it's not likely to be that material, just simply because of the relative size of those products relative to the total size of our portfolio.
Got it. Thank you, David.
No problem.
Thank you. Your final question comes from Marcus Curley from UBS. Please go ahead.
Good afternoon. David, I just wonder if you could quantify the market headwinds you're expecting to face in 25. Specifically, I suppose, how it relates to China label and maybe your aspirations to grow your store count.
Store count. So, overall in the market, I think, Marcus, the total market's probably likely, it's hard to be specific, it's probably still likely to decline mid-single digits in value. In terms of China label has been underperforming as a category versus English label, so down 12.5%. And in a way, and particularly in the MBS channel in K&A cities as well, where we obviously over-index too. So that is a headwind to us. Against that, we have a great opportunity in BCD cities to expand our distribution. which we have been doing. And I actually didn't include it in the chart here, but we've grown. I think it's in our results commentary and outlook. You'll see that we grew our store count to 29,000, so that's up about 3,000 from the half, which is primarily related to expansion of distribution in BCD cities. So we have a great opportunity to increase our distribution in BCD cities going forward, and we have much lower share there at 3%. That's a big opportunity for us. But there's definitely market headwinds in terms of total growth and China label, and we over-index towards where that is impacting. But we're at a great opportunity in BCD cities and also in online, where we under-index as well. And the online channel, like many categories, is growing ahead of offline at the moment.
And then just quickly, within English label, are you anticipating any share losses, in that guidance number of 5%? It feels like, English label already in growth, potentially market goes a little stronger for English label next year, yet, the 5% or slightly above 5% guidance. I did note that, in your pack, you're sort of alluding to or pointing to lower CBEC share. I just wondered if there's something happening in your share position in English label that's worth calling out.
No, we'd hope to maintain our share in English label, and I think over time we've got opportunity to increase our share. So hopefully the market for English label will continue to grow, and we will maintain, or hopefully, you would expect us to plan to improve that over time as well. So we're growing. So in CBEC, whilst when you look at SmartPath data, it's off a little bit, but that's SmartPath data that we report, which is basically the 4 major platforms plus flagship stores. But we're progressively working on our more direct engagement with C2C and POP stores, which is improving. Douyin, which is a great opportunity for us, which is outside our reported numbers there. Our O2O partnership with UO has been really positive as well. So there's lots of opportunities for us to continue to grow in English label, and a measured view on that is included within our guidance.
Okay, thank you.
Thank you. There are no further questions at this time. I'll now hand back to Mr. Bortolussi for closing remarks.
Well, that's it for us. Thank you very much for joining the call today. I look forward to continuing our discussions with our analysts and investors over the next couple of weeks. Thank you very much.